We are standing at a fascinating intersection of technology and capital today. Welcome back to US Stockpicker Podcast. Today is April 16th, 2026, and we are looking at a market phenomenon that forces us to ask a very profound question. Are we merely trading a stock, or are we pricing in the next evolutionary leap in human computing? The company in question is NVIDIA. It has just decisively broken through a massive long-term resistance level at $195, currently testing the psychological $200 barrier. But what is truly captivating is not just the price action. It is the underlying machinery driving it. We are seeing the launch of something called Ising, an open-source quantum AI model alongside a staggering 71% gross margin. It feels like the narrative has fundamentally shifted from speculative hype to undeniable, realized earnings power.
That shift is exactly what the data is screaming right now. When you look at the fundamentals, the numbers are almost entirely unheard of in the hardware industry. We are talking about a 104% return on equity and a 55% net profit margin. Those are the kinds of elite margins you typically only see reserved for high-end software monopolies, not companies that deal in physical silicon. And the reason they can pull this off is their fabless model. They design the architecture and outsource the heavy, capital-intensive manufacturing to partners like TSMC. It keeps them incredibly lean. They have a debt-to-equity ratio of just 0.07. That is essentially negligible debt. They are converting sales to cash at a blinding speed, generating nearly $4 of free cash flow per share.
It is a fortress of a balance sheet. But let us take a step back and look at the demand side. For the past year, there has been this lingering anxiety in the broader market about AI fatigue. The fear that the hyperscalers, the Microsofts, the Googles, the Metas of the world would eventually scale back their capital expenditures. Yet, the supply chain proxy data tells a completely different story. TSMC, which is NVIDIA's sole foundry partner, just reported record quarterly revenue. That feels like the ultimate proof of concept. It proves that the demand for high-end AI infrastructure is not just a theoretical projection. It is a physical backlog of orders that are currently being fulfilled.
Precisely. The TSMC data is the undeniable footprint in the sand. It completely debunks the AI fatigue theory. And the primary engine for that revenue right now is the Blackwell GPU architecture production ramp. But what really caught my attention over the last 48 hours is the software expansion. You mentioned Ising earlier. By introducing an open source family of AI models specifically for quantum computing, NVIDIA is signaling a massive strategic pivot. They are no longer content, just being the hardware backbone. They are aggressively moving into the software and specialized hybrid computing layers. Think of it this way. If their GPUs are the engine of the AI vehicle, Ising is them building the entire navigation system for the quantum realm. It makes their ecosystem incredibly sticky and almost impossible to replace.
That is a brilliant analogy. And it brings up a deeper, almost philosophical point about market dominance. When a single entity controls both the physical infrastructure and the quantum software pathways of the future, the economic moat becomes practically insurmountable. But as with all things in the market, we have to weigh the cost of admission. The stock is trading at a trailing PE of 40x and a price to sales of 22x. By traditional metrics, that is incredibly expensive. It requires the company to consistently hit aggressive, triple-digit growth targets just to justify its current existence at this price. How do we reconcile that premium valuation with the reality of the current market?
You reconcile it by adjusting for growth. Yes, a 40x multiple looks steep in a vacuum, but when you look at the forward PEG ratio, it sits at a very reasonable 1.19. That implies the price is actually quite attractive relative to its explosive growth rate. Revenue and earnings are projected to grow by roughly 65% in the coming fiscal year. And they are defending that lead by pouring nearly 9% of their massive revenue right back into research and development. Wall Street clearly sees this. We just saw BTIG and Citigroup reiterate buy ratings, and Zacks added it to their strong buy growth list. The median price target is sitting all the way up at $270.
However, we must remain objective and look at the friction points. It is never a straight line up. I am looking at the recent SEC filings, and there is a noticeable wave of institutional profit-taking. Cyprus funds cut their holdings by over 20%, Toth Financial trimmed by 14%. We are also seeing reports of insider selling following the recent $1 trillion AI pipeline announcement. Furthermore, Vanda Research is showing that retail momentum is slightly pivoting away from NVIDIA and toward Tesla right now. Add in the ongoing geopolitical sensitivities regarding AI chip exports to China, and you have a cocktail of headline risks. How much weight should we give these bear signals?
You have to respect them, but you also have to contextualize them. Institutional profit-taking near a major psychological level like $200 is standard portfolio rebalancing. It is the smart money locking in gains, but it does not necessarily mean they believe the core thesis is broken. The retail pivot to Tesla is actually a minor negative. It just means the momentum support might thin out temporarily as traders chase dips elsewhere. The geopolitical friction, however, is the real headline risk. Jensen Huang has been working overtime to navigate the China export restrictions. If new regulatory blockades on high-end GPUs are implemented, or if gross margins compress below 65% due to supply chain costs, that is when the bear case gains real teeth.
That brings us perfectly to the technical picture and the swing trade setup. The stock has been in an absolute blue skies trend. It has surged 7% in just 2 days. It is sitting comfortably above the 50-day moving average of $182 and the 200-day of $181. We have a MACD buy signal with an expanding histogram, and the RSI is hovering around 69.77. It shows intense buying pressure, but it has not quite reached that fully exhausted, overbought territory yet. The $195 ceiling has effectively flipped into a support floor.
Exactly. For swing traders, the path of least resistance is unequivocally upward. The breakout above 195s on heavy volume, averaging around 160 million shares, is a classic momentum signal. The broader technology sector is showing massive relative strength, acting as a tailwind. And with the broader market hitting record highs while volatility trends lower, we are in a definitive risk-on environment. The intraday charts, the 1 hour and 4 hour, are painting a beautiful sequence of higher highs and higher lows. Every minor dip is being aggressively bought.
It is a remarkable convergence of technical momentum and fundamental validation. As we watch this play out, it forces us to consider the broader societal impact. We are funding an intelligence revolution. The capital flowing into these data centers today will dictate the technological capabilities of humanity tomorrow. But as investors, our primary duty is to manage risk and allocate capital efficiently. Before we wrap up today's discussion, let us synthesize all of this data into a clear, actionable strategy. Based on the insights from US Stockpicker Podcast channel name US Stockpicker Podcast, let us walk through the definitive blueprint for this setup.
Let us break it down. First, the new sentiment analysis is a strong positive, heavily driven by the Ising quantum AI launch and the technical breakout, though slightly tempered by institutional profit-taking. Second, the fundamental analysis shows an exceptional business model with elite 71% gross margins, a 104% return on equity, and a highly attractive forward peg of 1.19, proving the underlying cash flow justifies the premium. Third, the swing trade analysis indicates a clear long setup and momentum breakout, with the stock trading well above its major moving averages, and momentum indicators flashing buy signals.
Which leads us to the critical execution phase. Fourth, the buy and sell recommendation of when to start investing. The optimal time to initiate a position is when the stock confirms this breakout by holding its ground, rather than chasing the immediate emotional surge. Fifth, what price point to start investing at? Cautious investors should look for a low-risk entry point during a slight retest of the $195 to $197 zone, or alternatively, enter upon a clean, confirmed daily close above the $200 psychological barrier. Sixth, when to leave the market. You exit if the core thesis invalidates. Specifically, if we see a broader market rotation out of growth into value, or if fundamental gross margins compress below 65%. Finally, what price point to leave the market at to mitigate risk? A strict stop loss should be placed just below the $190 level, as a daily close below that mark would suggest the recent breakout was a fake-out, breaking the bullish swing thesis.
That is a highly disciplined approach. It strips away the emotional hype of the AI gold rush and focuses purely on risk-adjusted mechanics. The technology is revolutionary, but the trade still requires strict parameters.
Absolutely. It is about participating in the future without risking your own present. Thank you for joining us on this deep dive into the mechanics of tomorrow.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. Video title, NVDA, $200, breakout, stocks do trade. Podcast reveals growth stock picks and upside potential stocks. Technology stock predictions for pop stocks.